So what is a reverse mortgage? A reverse mortgage is nothing more than a loan on your home's equity that individuals can get if they are 62 years of age or older, typically, and this loan is going to pay you retirement income from your home's mortgage. And this particular type of loan is aimed at the individuals who have either paid off their mortgage, therefore they have 100% equity in their home, or they have paid off most of it, therefore having a lot of equity in their home from which to do the reverse mortgage on. This is really similar to a HELOC in the way that we are taking home equity and we are using it for some loan for some reason. We are taking that money out of our home, and it's no different really with a reverse mortgage. They're just using this to create retirement income for themselves typically that they wouldn't have had otherwise, but it is still a loan on your home's equity. So with a reverse mortgage, you don't make payments on your home's principal. The bank is paying you payments back from the home's equity, but they are also charging you interest at the same time, which is the weird part of this, is that you're receiving this money, but they're still charging you interest at the same time. And the reason a lot of people find the idea of a reverse mortgage interesting is because they don't have to pay back any of the equity or the interest until they sell the home. So it makes it seem really easy to just go ahead and do this and take the money off of it, especially if they're not going to sell the house. But here's the cringeworthy thing. Here's the thing that makes you go, ooh, I don't like that. If you are to die before selling your home, therefore paying back the reverse mortgage, then what will happen to the people you leave your home to is that they will have two options. They will either have to go about paying off the mortgage with the interest, or they will have to surrender your home to the bank. Neither of which is a great idea, and neither of which is leaving anything substantial behind for your children or any of your heirs. So it might seem like a reverse mortgage is a good option to keep cash flow coming in, but it is a big risk to these homeowners and their heirs as these people go into retirement. There are really only three types of reverse mortgages, and those would be the Federal Housing Administration reverse mortgage. There is the single purpose reverse mortgage and the proprietary reverse mortgage. And all of these work in similar ways, but let's kind of talk about what the distinct differences are between these three types. That way you will know and know what to look out for. The Federal Housing Administration, or the HECM reverse mortgages, those are given to these individuals who are 62 or older, and these individuals go and they can use the money that they get from the reverse mortgage for whatever it may be. The problem is this, is that if your house is worth more than a certain amount, it could be an issue because the FHA, the Federal Housing Administration, keeps such a tight leash on these particular types of loans, on these individuals, that they want to make sure that they don't default on their loans. They want to make sure that they get paid back. Therefore, what they will do is they won't let individuals of a certain house price or above take out these reverse mortgages. And then the ones that they do, those have to pay insurance premiums. So if you'll remember, like when we were talking about the private mortgage insurance on mortgages, it's a similar thing, because remember the FHA would make you keep that the entire time. Well, in this case, they're going to make you pay these insurance premiums as you have your reverse mortgage. So it becomes really costly to do so. And this insurance, it is not for you, it is for the lender. So you don't get any protection from it. It is simply the lender, in the same way of PMI, the way that is a protection for the lender and not the homeowner itself. And this HECM reverse mortgage is the most common type. It came out in 1988, and it's the most common type that people take out. And these are not going to be much different than the other two types, but the other two have some basic caveats that are a tad different. So we move to the proprietary reverse mortgage. So proprietary reverse mortgages are not federally regulated like the FHA reverse mortgages. Therefore, these have more leeway. They have more that they can work with as far as giving out these loans to these individuals. And because they're not regulated, they can promise these higher loan amounts. They can promise that you'll get more for what we're gonna what we could offer you, what your home is worth. You will get more for what your home is worth. And the catch is that there are going to be much higher interest rates on these loans, and these are all given out by these private institutions. Therefore, they're willing to take on a little more risk than the federal government is. And these types of reverse mortgages even can allow the individuals to borrow more than they would be able to with the FHA's maximum. So the FHA, like we said, has this certain amount that if you get to it, they're not going to give you a reverse mortgage because they're trying to make sure that they get paid back. Well, these lenders can exceed that amount, and that sounds good for the particular individual, but it can be detrimental because there's just more debt on your home and more debt that either you're going to have to pay back or the people who you leave your estate to are going to have to pay back. Either way, it is more debt on your home, and you don't want that, especially when it can lead to such risk for you and the individuals who you leave your money to. So then lastly, we have the single purpose reverse mortgage, and these differ because if you think about the name, single purpose, they can only be used for singular purposes. And these are given out by states and local lenders and these governmental agencies, and they put the bounds on what you can spend this money on. So instead of just being able to use it for anything like the first two types of reverse mortgage that we talked about, so with this type of reverse mortgage, you can only use the money for property tax payments or home improvements or things of that nature. Therefore, you are restricted in what you can spend the money on. So the main idea of this type of reverse mortgage is that they want to give individuals money so they can stay in their homes if they fall behind on things like the homeowners insurance or property tax payments. They want you to be able to stay in your home. And in a similar way, if you need to make big house repairs, they still want you to be able to stay in your home and not have to sell. So that is the benefit of all this, is that if you did fall to that point, there's always that to run to. But it doesn't make it any safer than the first two types of reverse mortgages we talked about. And since these are just used for single purposes, they typically offer less in the amount that they will give you for however much equity you have in your home. And not only do they offer less, since these loans aren't federally regulated, then there are no mortgage insurance premiums like there was in the HECM reverse mortgage.